Well, hello, hey, it's Jamie here with Reese Homes, and it is tax season, and wanted to chat with you a little bit. If you're a seller who's sold a property, especially your principal residence, in the past year, and you're filing your taxes, it may be time to consider whether or not you can take advantage of the capital gains exclusion for primary residences. Now, what is this? This is an exclusion, not a deduction. So, an exclusion, it means that this is money that you just don't have to pay taxes on versus deduction would be things like if you've paid mortgage interest, that it deduces or is a deduction from your taxable income. It lowers your taxable income. Excluded income is income that just isn't taxable. So in this case, it's not taxable if you gain up to $500,000 as a married couple or $250,000 as a single person on the sale of your principal residence that you have resided in for 2 of the last 5 years. Now, those are the basics. There are some further details, but that covers most of the major criteria behind this exclusion. So if these apply, then you'll definitely want to look into whether or not you can take advantage of this exclusion. Now, how do you calculate what the gain is? How, when we talk about up to $500,000, what we want to look at is we want to look at the sales price. What did the property just sell for? Right? And that's going to start with at the top line. And then what you're going to reduce that is essentially the costs of the property when you started, so your purchase price, plus whatever you paid to acquire the property. This could be anything from the administrative fees, the non-interest or origination fees that you were probably able to deduct as mortgage interest before, but anything else related to the mortgage, title insurance, escrow, inspections, things like that, the cost that it took to help you buy that property, those can be added to your purchase price or your acquisition costs. And then you also want to look at removing the sale costs. What did it take you to sell the property? And we'll see those in this report a little bit later. And then any other capital improvement items that you made to the property during your ownership. Now, it's very important that this can't be maintenance. This can't be, going out and mowing the lawn or cleaning the driveway or something like that. However, if you went out and replaced a roof, you remodeled a kitchen, you added a bathroom, something of that nature where you made a capital improvement, you can add that to your overall cost of the property over time. So you add your purchase price, your acquisition cost, your sale cost, your capital improvements, you add all those together and reduce them from the sale price, and you get your capital gain, which in this case, I'm just estimating, is $275,000. Now, if this person who was selling was married, then there's no tax on it. They can just move forward, no tax, and nothing to worry about. If, on the other hand, this person were single, then they would exclude the first $250,000 of capital gains and then pay capital gains tax on the remaining $25,574. Hopefully all of that makes sense. Now, why do I have um, a seller's settlement statement pulled up here? And the reason is I want to show you these are the things that you want to look for in your sale costs. So the first thing that we see here is the sale price of the property. Don't need to worry about that. That helps you define the top line there. The next one is county taxes. County taxes aren't considered part of the cost of the property. And in fact, they are tax deductible in a whole other area, something that you should be looking at trying to deduct in your annual taxes, just not upon just the year that you sell the property. Now, when you look at costs of sale, these are what you're going to be looking at. Commissions, so the costs that it took to market and sell the property, the title and escrow charges, and the taxes that you paid, the sales taxes, and what we call sales tax on a real property is excise tax in the state of Washington. So this is the sales tax on the property. So these three items are what you really want to look at and be using to help reduce your overall gain. Make sure that you're reflecting your cost of sale property. The payoff of your mortgage, that's not included. You might be able to, if you were particularly aggressive in terms of taxes, you might be able to go out there and say, hey, I'm going to call the fee of ordering a payoff fee from a mortgage company part of my cost of sale, because I wouldn't go out there and request that if I wasn't selling the property. That's probably on the aggressive side for taxes. Nonetheless, it is a cost of sale. The water bill or things like that, that's certainly not something that you could reduce your overall capital gain with, right? Because that's just a maintenance for the property. So those are the things that you want to be looking for. Now, keep in mind, we are not tax professionals. We're doing our very best to help you understand the tax benefits of home ownership and how to take advantage of those. We can absolutely, if you have any questions about that, we are eager to answer those. Please contact us by phone or by email. And we can also, if you'd like some help, some professional help through this, we absolutely can refer you to really excellent CPAs and tax preparers who can walk you through this in greater detail and confirm that all of these tax deductions and exemptions are applicable to your circumstances. Thanks for watching, and we'll look forward to connecting with you soon.